Hey, welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today I'm doing a stock comparison. We're going to look at Uber versus Lyft. Which one is the better buy for the long term? Let's find out. And of course, before we get started, hey, if you like personal finance videos, stock analysis, and investment ideas, then be sure to subscribe to the 40 Finance channel. I appreciate everybody's support so far. All right, first stock on the board today is Uber, ticker symbol Uber. And what we have with Uber right now is we got a stock price of $32. 52-week range as of today was between $47 and $25. So literally sitting, just about in the middle of what it's been doing. And this stock went live in May of 2019. So we don't have a full year's worth of data yet. But to be honest with you, with an IPO like this, historical track record is going to take a long time to draw any sort of conclusions from. Market cap right now stands at $55 billion, and we'll see that that is roughly 5 to 6 times the size of Lyft. So Uber is far and away the bigger company. From a profitability standpoint, though, both these companies are not profitable yet. There's no PE, no forward PE. We'll look at some other metrics here in a minute. Uber has called out the potential for profitability, at least to eke out some profits by Q3 or Q4 here of 2020. We'll see if that actually materializes given the state of health concerns and stock market pullbacks. However, that is their big announcement that they rolled into 2020 with. All right, next on the board is, of course, Lyft. And with Lyft, you have a stock that came out roughly the same time as Uber, just about as old. They actually launched a couple months ahead of Uber, which is obviously a smart idea if you can get to the stock market first. They launched in March. You've had a 52-week range, though, wide-ranging 52-week span between $35 and $88. Market cap today stands at $11 billion versus Uber's $55 billion. And of course, no PE, no forward PE. And in terms of Lyft, they have been asked questions about profitability. Their target is sometime in the year 2021. All right, so let's take a look at some of the balance sheets between these two and compare. On the total cash standpoint, Uber has $11 billion on hand versus Lyft. Debt, Uber is at $7.84 billion, Lyft is about $500 million, so substantial difference in debt. And book value per share, Uber at $827, Lyft at $943. So on the balance sheet side of things, you got a company with Lyft that's done a really good job of spinning up and managing their debt load. At the end of the day, though, they're simply just not as big as Uber. Uber's $11 billion in cash versus $8 billion in debt is really not that bad of a place to be. They're obviously burning a ton of money. And what we'll eventually see is they're just spread out across more categories, Uber is. They have more plays, so to speak, in their market than Lyft does. That being said, there is a case for Lyft, without having a hefty debt load, with managing only one core business, and that is the driver and rideshare business. As much as we would like to probably bucket Uber and Lyft in the same area, they do have sort of a wildly different profile in terms of future business model. All right, looking at the TipRank's best performing analysts, we have over 20 analysts covering Uber. We have 19 buys, 2 holds, 12-month target of $49.94. That's the average target against all of the analysts. You've got a high of 59 and a low target of 40. So right now that's a 55% upside. Now this video is coming off of the February stock market correction, so depending on where you're watching it, we're sort of like hovering around the low point of the year, so to speak. But you got a nice upside here. You got potential profitability in the near future. I would say with Uber, at least from my standpoint, it might be worth a play, or at the very least, make sure that you have an ETF with some Uber exposure. All right, same thing, tip ranks on the Lyft side of the coin. We have 18 buys and 5 holds, so very strong rating, a couple more holds than Uber has. You have an 84% median upside. And what analysts are seeing here with Lyft is really more growth as a percentage of total business, right? Lyft, being the smaller company, has bigger targets ahead of it that it can achieve in the next year or two. But I think when it gets to that 5 or 10 year line, things get a little harder for Lyft to compete against Uber, at least in today's landscape. But from a short-term buy situation, let's just say 6 months to 18 months, Lyft may actually produce more stock investment profits for you as an investor. Neither company has dividends, so who will be able to showcase more growth in the short term? That would be Lyft. However, there is a catch because Uber, in my opinion, is developing multiple long-term revenue streams. Okay, so at the end of the day, from a long-term investment standpoint, my chips are on Uber versus Lyft. I think they both have some intriguing investment qualities, and I think both of them will produce growth in their stock price in the future. But again, if you're looking for something to go from that 0 to Amazon or 0 to Apple, I'm not sure either of these is exactly that, but Uber is certainly the closer of the two companies in that regard. When you think about the different categories that they're playing in right now, with the Uber Eats, obviously the ride sharing, and I think the more intriguing developments that they have coming out are with freight hauling, business travel. You even have the bikes and the Uber Elevate, which is supposed to be a helicopter service. I'm sure some of those are going to take time to be more applicable to the average human being. But the bottom line is they're thinking about their technology and how they transport people in a much, much broader scale than Lyft is. And that doesn't mean Lyft's a bad company. They're staying in their lane. They have a partnership with Google's Waymo to try to develop some driverless taxis. And I think they're doing good things. But on a pure innovation scale, Uber is ahead of Lyft on innovation, and they're ahead on size of the company, and they're ahead on size of revenue, and they will be ahead on the size of profits. So from a long-term standpoint, I'm with Uber. And one of the things I read that sort of firmly put me in this position was from an Argus research report, and I'll highlight it here. Uber's share of total personal mobility is less than 1% in every major region in which it operates. Uber believes that the total available market for personal mobility is $5.7 trillion annually, including $2.5 trillion within its current service addressable market. So ultimately, Uber thinks that they're serving about 1% of their addressable market. So this is really exciting. And it doesn't mean that they'll get to 100%. I'd be surprised. Frankly, it's going to take decades to get to 40%. However, 1% of where you are today versus what's ahead of you in the future, I like Uber in this case, at least between these two companies. And I would definitely say, at the worst case scenario, look for an ETF, a long-term hold ETF that's got some exposure to Uber. Who knows? This could be the next 0 to Amazon or 0 to Apple. That's going to take a lot of time to figure out. But in the short term, both of these companies are going to produce stock gains for investors, and you don't want to miss out. All right, hope you guys enjoyed this video. Please give me a like and subscribe. I really appreciate your support. We'll see you on the next video.